So this is our first lecture covering chapters 1 through 4 of the Manias, Panics, and Crashes book. So what I want to do in this lecture is I want to give a overview of the book itself and an overview of the 4 chapters without delving into each individual chapter. The idea is that you can read each of the chapters of the book. I don't want to discourage you from doing that by summarizing each chapter. You've got the chapters in front of you. You're either reading it closely or you're not reading it closely. Neither is fine. I mean, what's important is what you get out of it in combination with the lectures. So what I'm going to try to do each of the weeks is make a PowerPoint that kind of guides some of my thoughts, and then I'm going to have some free talking as well, where there's no slides, but I'm kind of expanding upon it outside of what's on the slides. Okay. So, and I'm just kind of, I before this lecture, I basically have a notebook and I'm kind of writing out some notes to you. So if you hear papers rustling, that's why. So the Kindleberger text, the Manias, Panics, and Crashes book, what it essentially does is it looks at financial crises from 1600 all the way to the present. In my case, I'm following the 6th edition, so it's taking me out to 2012. But there hasn't been any crises, at least in the United States, since that point. So, and so in that period of time from 1600 to 2012, he documented about 40 cases of a mania, panic, or crash. And the reason why the book is so good, because essentially what he does is he looks for the trends. He looks for the commonalities in these 40 cases over 400-year time period. I mean, what's really interesting about it is that, for instance, in the 1800s, you actually have more years where you're in a financial crisis than you're not in a financial crisis. And to document where all of these financial crises are and what their commonalities are, he uses a model from Hyman Minsky. So a Minsky model, I'm going to talk about it here in the slides when I start going through each of these individual ones. But the Minsky model basically sees a financial crisis as the end result of a process. And what happens is that people form expectations, and then there's enough credit, meaning money, to allow people to further their dreams, to try to meet these expectations. And then with all of that credit, they then end up in a mania or a panic of some kind. So let me. Oh, this was a really cool article, by the way. It was about how in Japan, almost everyone turns their stuff in. It's a really interesting article. There was this over a few weeks ago. I saw this commercial right here, and it's really interesting. Not sure how to make it.
How much for those?
For the troops? He took all of them at double the price. I made a fortune.
Tulips? Tulips?
Who will start me off at 40 guilders?
60 guilder each.
200, 240, 260.
I want more. Give me more.
I'll get it. 6,000.
I'll get you my house.
Sold. Because I'm overnight.
Watch me.
Why is a tulip worth so much? It's a tulip.
Tulip prices. Drop. Tulip.
had Gainbridge, they could have balanced risk with a straightforward high-rate annuity. As long as there's market uncertainty, there's Gainbridge.
So this is a commercial that's covering the quite famous Dutch tulip craze. And you see in that commercial, again, that everyone's thinking that these seeds, these tulip bulbs, basically are going to have all of the that this is going to be the asset. And you saw in there somewhat, too, that people then were using their existing assets to fuel that. And actually, if you look in the book, and again, I'm following the 6th edition, that tulip bulb bubble on page 11 of 1636, that is actually the top financial bubble. On that same list, the most recent financial crisis actually is number 10. So again, it's part of the reason why I didn't want to make this course only about the most recent financial crisis, because it was significant, but it was only in the top 10, so it wasn't like the be all and end all that it was made out to be. So what's causing this, right? So what is causing a crisis where again, the key lines here is that you have expectations financed by excessive credit creation that creates an excess or a mania. As an example of this, think of the most recent crisis that we had. That the idea was that only suckers rent their house or rent an apartment. That home ownership is the way to financial independence. And then people go out to the bank and they find it's incredibly easy to get a loan. And everyone then says, yeah, I made a lot of money flipping houses. I own 3 houses and I rent them to suckers who can't afford a house. So everyone's buying houses and bidding up the price, and then you have an excess or a mania. Why is this happening? Is it markets to blame? Not really. Right? It's that actually markets are quite efficient, at least according to Kindleberger, that what happens is that basically a series of events happen from an initial event or an initial circumstance. So sometimes that event or circumstance could be something like a famine or a war or a significant policy change. And what it does is it alters economic activity and it changes everything. So that process that Kindleberger identifies is called displacement. So the first thing you need to have here is displacement. Something happens that alters the events, that alters economic activity, and everything changes from that point. Most of the time, that economic event that's happening is a bad thing, again, like a war or a drought. But sometimes it's a good thing. Like when I first started my undergraduate degree in 1995, like the big idea there was everyone's going to get an email address and everyone was going to go on the World Wide Web. And then from 95 to 2000, everyone was making money starting an internet business. There's some really good movies that cover that time period. And again, I'm trying to make this a little bit of a somewhat interactive process here. But there's this really good movie. I don't know if it's this. It was a movie called E-Dreams. And well, if you come to my office, you and I can watch it. Anyway, here's the IMDb, at least for it. We don't have to watch you can buy it on Amazon, I guess. But basically, there was a company called Cosmo.com, and it shows how that business built itself up It's a documentary, built itself up before the stock market crash of 2000. It's a really good movie. And again, if you're looking for a copy, don't go out and buy it and just ask me. I'm sure I can find some way for you to get access to it. There's other good movies too, like Startup.com and not Law and Order, and a few others. Okay, let's go back to this. So sometimes the good thing is like that. Like in the stock market boom, everyone was like, oh my gosh, the economy has fundamentally changed because we don't need bricks and mortar stores right now. Things are going to be very efficient because everyone's just going to order stuff on Amazon. But retail isn't dead, right? Bricks and mortar retail is not dead. That, yes, Amazon is quite successful, but most of Amazon's competitors that were existed in the late 1990s do not exist anymore. And so what that means for us, that process of displacement, that can sometimes take a very long time, but that displacement always ends with a financial crisis of some kind that's fueled by people being incredibly optimistic about things. And I think it's actually useful to see financial crises as part of a process because it allows us to think of a crisis then as having multiple points where things can change a little bit, that the outcome could change a little bit based on things. Okay, so let's start now with the slides. These slides, again, I will be posting as well. Okay, so what is a bubble, basically? What is a mania or a panic here? Basically, it occurs when things are not sustainable. The price changes are not sustainable. So when you think of the real estate bubble that existed, you could see that houses couldn't possibly be worth as much as people were paying for it. And the reason why people didn't care how much they were paying for it was because they didn't intend to hold it that long. They were just going to flip it and buy something else. And so these asset prices that are rapidly increasing, and here in the book, as I outline here, it's when the price is going up over a 1 to 3 year time period when it's really going. And in our case, it was, you could say it started in the early 2000s, so really between 2005 and 2007 is when you had the bulk of the increase in this most latest crisis. The only reason why we could get what we got was because credit expanded so much. The exploration of how the credit grew so much, that's actually the role of other movies that are that came out not too long ago. That would be things like The Big Short, where if you've watched that movie, you kind of see how where all the money came from for home mortgages. And here's our list here. Right, that the only thing that, depending on how you date things, again on page 11, maybe we would count within the top 10, maybe the markets in the dot-com bust of the late 1990s, or you would put this most recent crisis. So these are the top 10 financial bubbles. This is coming from page 11 in the book. What's interesting about this, I guess, is some of these in Hawaii, like number 6, we do think of quite a bit because it obviously affected Hawaii quite greatly. But some of these, what's interesting about it is, like, for instance, the bubble bursting for the stock market in 1929. Yeah, it was important, but it was number 4. really the most severe ones are hundreds of years ago. Why was it so severe back then? Kindleberger might argue that we just didn't know enough about crises. Kind of what he hopes with this book is that we could actually identify the trends and try to stop it before it happens. But as you can see here, he wrote this book, I believe in the late 1970s, if I'm not mistaken. Actually trying to see when it was first. Yeah, first edition came out in 1978. Either not enough people are reading his book, or we're in a lot of problems because we can't alter things yet. A lot of these severe ones have been happening over the past 20 to 30 years. So let me repeat the line I said again because it is pretty important. Like, financial crises come out of a process. They're coming out of a process which is financed by excessive credit creation that results in an excess or a mania. So if the fire is already burning and that fire is the financial crisis, the fire will go out if it doesn't have any more fuel, right? Like wood or gasoline or whatever you're fueling it with. If that fuel runs out, the fire goes out, right? What makes a fire a big fire or a crisis a big crisis is if there's enough credit. And that's what creates the mania, right? So what oftentimes happens here, and we'll talk about this a bit as the course goes on, what happens is that sometimes the reaction after the mania has passed is to get rid of all the credit, right? Which is what happened in the 2008 financial crisis. That all of the credit that was out there, then mortgage lenders wouldn't lend out any money, and then the economy freezes completely, and that's not good either, right? Because again, without that credit, without that fuel, the fire goes out. With too much credit, it's like throwing gasoline on a fire; it will explode and get way too big. So again, you see, we've seen these again in real estate is the one of the more often times areas where we see these manias. Stocks, certain commodities like Bitcoin, not a large scale mania, but from time to time it has one, and a lot of it happens too when groups get overly optimistic. This over optimism comes from the fact that they keep thinking that the prices will go up more and more and more. So again, what we need is that displacement process. How the fire starts in the first place, right? How does the crisis start? And again, it starts by the outside event or that shock, which could be good or bad, but the bad ones are easy to understand. A start of a war, right? So in this case, World War I, which started in 1914. Famine is a pretty easy one to understand because the economy goes into crisis mode, and you see this in developing economies quite often. And what it means, like in these bad events, this displacement, what it means is that everyone's getting rid of their assets as fast as possible. A distress sale. And usually the first thing that starts this all off is someone having done something bad, right? So the revelation of misfeasance, malfeasance, malversation, these are all things where basically someone is tricking someone else. In this most recent crisis, the Bernie Madoff incident is a perfect example of that happening. And actually a really good documentary, which is also somewhat entertaining, is the HBO did one. I think it was just called like Bernie maybe, or I feel like I'm just giving you a whole bunch of movie recommendations right now. Wizard of Lies, that's what it was. Wizard of Lies, and it had some really good actors and actresses in it. I don't want to watch the whole thing. Um, but it was really good.
I went in. I am talking about giving you $100 million.
Right? So, right here, at a dinner party, one of these famous examples was that everyone saw Bernie Madoff, who basically ran a hedge fund, that everyone would give Bernie Madoff money because he was seen as like allowing their money to grow rapidly. But it was a trick. He actually never invested the money. He sometimes invested the money, but basically it was a pyramid scheme. By a pyramid scheme, meaning new investors were paying off the old investors who were cashing out. And the money was never invested. And because of Bernie Madoff and the credibility he had, everyone trusted him and didn't think that he would be tricking others.
That's not going to do it. 150. I'd love to help you, but I can't. 175. I wish I could. I'm just thinking of it. No, 275. $300 million. How far do we got to go? If you go above 4, we might have something. I can do that.
There's a little black spot on the sun.
How was Wall Street, Papa?
Wall Street is good.
Dad says things are bad at Wall Street.
You're an 8-year-old and you shouldn't be asking me questions like that. I don't feel like talking about Wall Street. I'm here having dinner with my family.
Bernie, what's wrong with you?
It's a fraud. Basically just a big Ponzi scheme.
What's a Ponzi scheme?
What are we going to do?
50 million?
50 billion with a B.
Mom, do you understand what he's done?
It's the same.
I'm tired of being hated. You got yourself into trouble. You couldn't get out. Why does the world hate me? They all think I'm some kind of a mastermind.
Take it as a compliment, Ruth.
You were never suspicious of your father? You're asking me how I didn't know? You're the FBI. How did you not know?
Okay, I'm not going to keep this going here. It's actually a pretty sad tale. The whether the sons knew or not, no one really knows. But I mean, Bernie is in prison, having admitted to the crimes. I think the wife got divorced from him. One of the sons committed suicide, and the other son basically can't get a job because no one trusts the family. And obviously, that is occurring right as the financial crisis is taking hold. Okay, so one of the things that the Meaniest Panics and Crashes book then does is it tries to understand then how credit grows. How is that process occurring about how credit grows? Well, there's two schools of thought of this. There's the currency school of thought and the banking school of thought. In your Econ 131 course, you may have been taught a monetarist's philosophy. That would be something like the currency school, which basically then says that we try to control the growth of the economy, of the currency, by placing a firm limit on how much it grows over time. So basically, we were able to limit inflation because you can't like expand credit that much if you're only growing the size of the money by 2% a year. But that will stop it pretty quickly, I would think. And part of that then, is how quickly you want it to grow, what that percent is going to be. That's all going to control how fast things grow. The other side of this is a banking school. And here, what we're seeing here is that we don't necessarily hit a firm limit like a 2% or 3% rule. Rather, what we do is that we allow the money supply to grow up until the point where there is no inflation. And so, as long as there's enough business transactions, as long as the economy is growing fast enough, we'll grow the money supply to accommodate that. But we're not going to expand the money supply greater than that rate needed to help the economy grow in size. So, what it does is it creates this cycle. A financial crisis is part of a process of a cycle where the economic growth is occurring, and the mania leads us to a boom or a bubble, which then eventually pops and leads to a panic and a crash. But eventually, that boom, bubble, and bust leads to another one, right? So the 1995 the dot-com bubble that burst in the year 2000 2001 basically created the conditions necessary for the 2008 financial crisis. So one crisis begets another, begets another. Now, the popping of the bubble, the issue then becomes, well, then do you try to control it or not? What is that? Bursting of the bubble? What is that going to look like? Well, there's two ways to really think about it. Is that it could be based that exuberance about the economy could either be rational or irrational, right? The rational exuberance would be that when when the internet first came out, right, when it first emerged, yes, things did fundamentally change and things were rational. But at some point, people kept thinking it can't keep increasing at this rate anymore. And eventually, things become unsustainable. Things become irrational. There's no market value to it. How we get to something being irrational can be structural, meaning that part of the economy doesn't stop things from becoming irrational, but can also be cultural and psychological, right? So one example of this that we saw most recently, and we're not even really sure how this is going to play out, would be some of the initial public offerings that were offered over the past year. One of the more famous examples being WeWork. So if you're not familiar with WeWork, right, this is kind of an interesting business. What it did is it basically bought large office space and then it broke it down into smaller parts and then rented that out to others to basically make money. I wouldn't want to watch this 13-minute movie from Bloomberg. I don't want to waste your time doing it, but I would suggest you do it. It's actually, I have watched it. I don't want to make the entire class watch it. But
is grammatically correct.
Bloomberg is a respected source here. And it'll give you a good idea of a more recent example of a exuberance that we seem to be in right now. So what are some of these structural factors? Well, part of it is this idea that the internet was part of this. Other things that are a part of this would be things like lowering taxes, and even the political environment is part of this. It's much easier to buy stocks and bonds than it used to be. Traditional pensions have gone away, and everyone now does things through their 401k, so there's all this money out there. And then things start to get amplified. And that amplification, right, occurs in things like this Ponzi process where, again, like the Madoff example, where people keep thinking it's going to go up, and so they realize they have to get in now, otherwise they're going to miss out on all the profits, right? There's never a bad time to get into the stock market, these days at least, and so that's fueling part of this. Then there's also psychological factors, right? And this would be the fact that if everyone's doing it, then I need to do it too. And, you know, for instance, I rent. I don't own a house. I can't tell you the number of times that someone comes up to me and asks, why do I, as an economist, rent when I could afford a house? Why do I still rent? Well, I mean, part of it is, I'm rather young. My family size is still growing, so I don't know actually how much space I'm going to need for the long term. So if I don't know something like that, why would I want to buy a house? But also, I think there are other assets out there that might grow just as quickly, if not actually more quickly, to kind of drive that forward. And I guess I haven't been convinced that the house is the best asset to have for that kind of thing. So then what you need to do then is you need to try to find some way to rationalize this. Right? We can come up with models, for instance, try to model the price. Sometimes things are mispriced, like in the tulip bubble, right, where there was no way to kind of track how prices were changing over time. Even with the housing market, it's really hard to track how efficient the market is and how those earnings are changing over time. But I mean, I'm personally, I'm a believer that markets are efficient, and I do believe in an efficient market theory. Right, this would be theories like dogs of the Dow, right? That the stocks that fell the most in one year, the next year, those are usually the ones that gain the most. Right, you could pick day trends or hourly trends, even of when certain stocks go up or down, and that these kinds of trends exist. In fact, if we tried to search this out here, I'm just doing a search here. I don't even know what. Let's just see what this is here. Yeah, I mean, right, you're seeing even in this Wikipedia entry, you see a few things here where it talks about basically ways in which you could time things and how mispricing occurs. Which would then run counter to the idea that markets are efficient and that the best prices are always there. Well, that these things exist diminishes the relevance of markets being efficient. But in general, they really are, I believe that they really are efficient. And again, this irrational exuberance is coming from the fact that there is this herd mentality, media promotes it, and it's encouraged by the fact that there are changes in the structure of the economy. And what people then try to do is they try to say that the high prices being charged are rational because the markets say they are, but even markets can sometimes get things wrong. One last thing that Kindleberger talks about in these first 4 chapters is also the role that's played by the lenders of last resort. Lenders of last resort means who is the one that bails everybody out when the bubble has burst, when the crisis has occurred? In the case of the United States, it's the Federal Reserve and the federal government. But we also have international lenders of last resort. That would be things like the World Bank and even other central banks around the world. It's a bad idea sometimes to have them. It creates a problem that economists know as moral hazard. It means that we all act a little bit less safely because we know that someone, equivalent of mommy and daddy, will bail us out. And it means that we take more risks than we otherwise should. This is basically what I outline here. But what it does do is it does stop a crisis or a panic. I like to show this kind of thing here. Oh, look at that. He looks scary, Senator Palpatine. Oh, he looks scary. So I'm just I'm not sure what I'm going to see here. So I'm typing in the Bear Stearns bailout by CNBC, and the bailout had occurred with by the Federal Reserve. I'm just trying to see here if I can see anything that's rather short. This might be interesting. I'm not sure if we'll watch this whole thing. I'm just
Hi,
seeing
Deborah
this.
Borchardt here, and I am joined with Jim Cramer, and we're looking at AIG, which it seems like every day we have a new company that is at the top of our list to watch.
There are only two companies that can't fail, AIG and Citigroup.
And let's talk
They
about
cannot
AIG.
fail. If
No.
they fail, we will not get the market open. Okay?
Really, they need help. So is that the question, is if the government helps them or not helps them? Is that...
Unfortunately, not the U.S. government that really needs to help AIG. It's Europe.
So here, basically, Jim Cramer, who's a pretty famous investor, he's having to identify here AIG, which was the big insurance company that almost failed in the 2008, 2009 financial crisis. Here, he's saying that maybe the U.S. government doesn't need to be the lender of last resort that the Europeans do.
Because the problems of AIG are really much more Europe-central than American-central.
Okay, so if they do not get help, what is the situation? What will happen?
Well, I mean, many of the banks that relied on AIG to be able to have AAA credit on portfolios will have their portfolios downgraded, which is why, like, for instance, UBS goes down every day. Well, UBS is probably interrelated to AIG. AIG has such terrible disclosure, we have no idea who their customers are. So
because their products are insured by...
Well, AIG insured a huge amount of financial products in Europe when they felt that in 2005 that this market was going down. Marty Sullivan led a charge over there to insure mortgage.
So I'm not going to play this whole thing here, but basically AIG was eventually bailed out by, well, I guess you can watch this here too, AIG. We own it. This was an explanation of that bailout process. And then there were others like Lehman Brothers, where we did not bail them out. And that would just be another side to that in terms of these lenders of last resort. Okay, and then again, the idea of the fraud. I mean, we see these frauds, we see these swindles, we see this credit cycle, we see this happening as the bubble is about to burst. And again, I'm assuming you can read these slides here. You don't need me to read that. Okay, so I think here in these, again, I'm assuming you can read the first 4 chapters. I'm kind of just adding a little bit more context to it than what you have written in the book. Let me talk a little bit about the current crisis that we may see ourselves in. And again, I'm a bit cautious about talking about this because it's hard to predict these kinds of things. It's not exactly known what you know what the crisis is going to be until it's actually already happening. But what we tend to see here is that one of the things that we see with Minsky and even what we see with Kindleberger is that stability causes instability. I'll repeat that again, that stability causes instability. That everyone thinks that everything is great, I don't need to look at things so closely, so then everyone lets their guard down and then things start to get really bad. So that people watch things more closely when the stock market falls 800 points, but they don't look at things at all if the market went up only 10 points or 20 points. And that makes sense, right? I mean, you wouldn't know it, but last year, 2019, the stock market was up 27% for the S&P 500. 27%. That's crazy. I mean, crazy in the sense that that's, a 27% increase, and there's no market change in the conditions of the economy that would cause the stock market to go up that much. And that's coupled with the fact that the price I have to pay for money, interest rates, that interest rates have never been lower than what they are right now. And I'll repeat that again. They have never been lower than what they are now. That in countries in Europe, the interest rate is negative, meaning you actually pay the bank to save your money. And what that means is that if I want to borrow money, borrowing money is also really, really cheap. So what we need to kind of look at here is, can the U.S. economy still then grow with the fact that people can borrow money so cheaply and basically finance everything? As other parts of the example of this, right, unemployment is incredibly low. It's almost never been as low as it is right now. Interest rates are as low as they've ever been right now. And basically, everyone's then taking their money and putting it into the same things. Like Bitcoins would be an example, right? That everyone's buying Bitcoins, that everyone's buying real estate, that everyone's buying, looks like they're buying stocks and bonds. Now, what that means is that from an investor standpoint, that people are reaching for yield. That what they're doing is that because, so my wife is in finance, she can't find her clients. She's managing about $100 million. She can't find clients, retired clients. She can't find them bonds. City and county of Hawaii, Honolulu bonds. She can't find them bonds, and they still want that really nice interest rate. She has to get lower and lower quality bonds to get that interest rate, right? And that's when you then start to reach junk territory, junk bonds. Junk bonds are where you don't exactly know if the creditor is going to pay you back or not. And normally a retiree wouldn't do that, but because they're reaching for yield, they're buying things they shouldn't. So an example that she just gave me, I asked her about this before the lecture, was Argentina. So Argentina has gone, as a country, has gone into default quite often. And in 2017, the country issued 100-year bonds and it got sold out. Everyone bought 100-year bonds from a country that has defaulted. My best guess, if I had to make a quick guess, has probably defaulted, meaning saying we are bankrupt, we are paying nothing, has probably defaulted over the past 100 years, has probably defaulted at least 10 times. So why would you buy a bond where the country has defaulted, gone bankrupt 10 times, and in default, all the bonds are wiped out? Why would you buy a 100-year bond from that country? Because you're probably not expecting to hold on to it for 100 years. So then it's like the real estate bubble, hot potato, hot potato. Greece, a country that has also gone into default. People are buying their bonds and they're only getting paid 1% to buy a bond from Greece, a country that has failed as well in terms of going into default. So basically what we're seeing here is that not enough people are worried. I'm not sure that people are looking at Argentina and how often it's failed when they're buying the 100-year bond, or that they're only going to ask from Greece for a 1% premium, given how often it also defaults, only asking for a 1% reward. People aren't worried enough. People aren't fearful enough. There really is a problem. And And what it does is it starts to create a so sometimes we see the bubbles do create these problems, and the problems are like, for instance, all these vacant homes or something like that. But also what we could see here as well is that if we have stability causing instability, which again is kind of what I'm arguing we have right now, we have stability right now, and people are then not worried or fearful, and it's going to cause instability, that basically what's going to start to happen here is that people go into either incredibly risky things like that Argentina bond or the Greece bond, or they actually start stealing things like the Ponzi schemes. And it's that reach for the yield that then fuels the crisis. Now, what that means for us is that if we look at how much is out there where the interest rate is negative. I'm just going to type this in really fast here just to see if I can find this. This is a little bit dated, so keep in mind this is from 2019. From August, obviously, from last year, but August of last year. I'm just trying to see here if there's a chart. Yeah, there is right here. Look at that. So this is how many bonds are out there right now that pay a negative interest rate, meaning you pay the bank something to save your money there. Look how much that is. $15 trillion. When just 5 years ago, there was nothing. That's got to cause some problem, I would think. If all this money can be out there and it's incredibly free to get. And when yields are that low, again, if the interest rate is negative and you're thinking, why would I ever buy that? That's part of the problem. Because then if you don't buy that, you're going to buy something else, in turn causing part of the crisis. And so that's why this class, in my kind of closing comments here, that's why this class is so important, because basically what we're going to do here, as we read these later chapters here, is we're going to explore then how we see these crises around us and what it means for the next crisis that happens, because there will be a next crisis that does happen.